This month could be the moment silver investors either get rich or get left behind. Right now, silver is sitting at a crossroads nobody saw coming just a few months ago. In January of this year, silver exploded to an all-time high above $121 an ounce. Then, in a matter of weeks, it lost nearly half its value. Now, heading into July, silver is trading in the mid-60s, caught between fear and opportunity. But here's what almost nobody's talking about. The very forces that crashed silver are now quietly setting up the next major move. And depending on how the next few weeks unfold, that move could be explosive. I'm going to walk you through exactly what happened, why it matters, and what could happen next. Because if you understand this setup before the rest of the market does, you could be positioned months ahead of everyone else. Let's start with why silver collapsed in the first place. When silver surged past $100 in late January, the exchange that controls global futures trading stepped in. Margin requirements were hiked sharply, forcing leveraged traders to either post more collateral or liquidate their positions. That triggered a wave of forced selling that fed on itself. At the same time, the Federal Reserve signaled something the market did not want to hear. Rate cuts were pushed further out, and a hawkish tone from the June policy meeting sent shockwaves through every corner of the metals market. The dollar index responded by climbing to its highest level in over a year. And here's the relationship you need to understand. When the dollar strengthens, silver becomes more expensive for buyers in Europe, in Asia, and across emerging markets. Global demand softens almost instantly. This changes everything for silver investors, because it means the recent crash was not about silver losing its fundamental value. It was about leverage, margin calls, and a stronger dollar squeezing the market all at once. The metal itself did not become less scarce. If anything, it became more scarce. Now pay close attention, because this is where the story gets serious. The Silver Institute has confirmed that 2026 marks the 6th consecutive year of a global silver supply deficit. Industrial demand from solar panel manufacturing, electric vehicles, and next-generation electronics continues to outpace what mines can produce. Above-ground stockpiles are being drawn down year after year. That is not a short-term imbalance. That is a structural deficit that has been building for half a decade. And when supply keeps falling short of demand, year after year the pressure does not disappear. It compounds. Meanwhile, the gold-to-silver ratio has widened back out to around 64-1 after briefly compressing earlier this year. Historically, that ratio tends to snap back toward the long-term average whenever gold's momentum resumes. That means silver is now trading cheap relative to gold, even after everything that has happened. This is exactly why smart money is moving early, positioning for a ratio correction before the broader market catches on. Institutional forecasters have not walked away from silver, despite the volatility. JP Morgan projects an average price near $81 an ounce for silver across this year. Commerzbank has set a year-end target near $90, with further upside projected into next year. Some banks have laid out bull case scenarios stretching well beyond $100 if physical shortages intensify. These are not fringe predictions. These are major financial institutions telling their clients that the long-term silver story remains intact. But let's be honest about the risks, because this channel does not deal in blind hype. There is a real bear case, and you need to understand it. If the Federal Reserve maintains its hawkish stance through the summer and the dollar continues to strengthen, silver could face renewed selling pressure. A break below the key $50 support zone is not out of the question. If that happens, we could see a deeper pullback before any meaningful recovery begins. Higher for longer interest rates increase the opportunity cost of holding a non-yielding asset like silver. That is the honest, unfiltered risk sitting on the table right now. What happens next could shock most investors in either direction. So let's talk about the two scenarios that matter most this month. In the bullish scenario, softer economic data out of the United States forces the Federal Reserve to soften its tone. Treasury yields ease, the dollar retreats from its highs, and safe haven demand returns to the metals complex. If silver can close decisively above the resistance zone near $68, momentum traders and algorithmic funds are likely to pile back in. That kind of breakout could send silver testing the psychological $80 level within weeks, not months. Combine that with a structural supply deficit and returning industrial demand, and you have the ingredients for a violent upside move. In the bearish scenario, the Fed holds firm, inflation data comes in hotter than expected due to elevated energy prices, and the dollar pushes to fresh highs. In that environment, silver could break down through its support zone and retest levels closer to $50 before buyers step back in. For long-term holders, that kind of pullback would not represent a broken thesis. It would represent an opportunity to accumulate at a discount before the structural deficit reasserts itself. Now think about what this means for you as a European or international investor. You're not just watching a commodity chart, you are watching a referendum on currency stability, central bank credibility, and the future purchasing power of your savings. The euro and the dollar are both under pressure from years of expansive monetary policy, mounting sovereign debt, and geopolitical fault lines that refuse to close. Every time a central bank hesitates, delays, or reverses course, it sends a signal to the market that trust in paper currency is not unconditional. Silver, unlike a currency, cannot be printed into existence by a policy meeting. That is precisely why it has remained a core hedge against currency devaluation for centuries, and why it continues to matter today. Geopolitical risk adds another layer of urgency to this picture. Trade tensions, regional conflicts, and shifting alliances between major economies all increase the odds of sudden capital flight into hard assets. Central banks around the world have been accumulating gold at a record pace for several years now, and history shows that silver tends to follow gold's lead once the broader precious metal cycle regains momentum. When that rotation happens, it often happens fast, and it often catches retail investors on the sidelines. So, where does that leave us heading into July? This month is likely to be defined by one critical question. Does the Federal Reserve blink, or does it hold the line? That single decision point will determine whether silver breaks higher toward resistance or retests support to the downside. Either way, the structural story underneath the price action has not changed. 5, now 6, consecutive years of supply deficits do not resolve themselves overnight. Industrial demand from the energy transition is not slowing down, and a gold to silver ratio sitting well above its historical average suggests silver still has room to catch up. The traders who position before the breakout rather than chasing it after the fact are the ones who tend to capture the largest gains. The investors who wait for confirmation often end up buying the top of the move instead of the beginning. This is not a call to gamble on short-term price swings. This is a call to understand the forces at play so that whatever happens this month does not catch you off guard. Whether silver breaks toward $80 or pulls back toward 51st, the long-term deficit story remains the same, and that story still favors those who prepare early. If this breakdown helped you understand what is really driving silver right now, make sure you are subscribed and have notifications turned on, because this market is moving fast, and the next update could come within days, not weeks. Drop a comment below with the word silver if you believe this month brings the breakout, or gold if you think the safer trade is still in the yellow metal. Either way, stay ready, because the biggest moves in this market rarely announce themselves in advance.